is going to be all about averaging up and averaging down. Now, what is averaging up and what is averaging down? Simply enough, just showing a quick little definition here, is averaging down is an investing strategy that involves a stock owner purchasing additional shares of a previous initiated investment after the price has dropped. The result is the second purchase decreases the average price at which investors purchase the stock. It may be contrasted with averaging up. So I know that sounds very confusing. So let's break down the most simple averaging up or averaging down strategies, and let's make sure you understand how you can use them and how you can make more money. So first thing we want to talk about is that definition kind of confused me a little bit. What does averaging down or averaging up really means? So we're going to start with if you are buying a stock. If you are buying a stock, how can you make sure that you are getting one of the best entries possible? And how you're going to want to do that is by averaging up. So what we have here, or averaging down, is let's say there's a stock and the stock is coming down to the price of $5. When a stock spikes its way all the way on up and starts coming back on down towards $5, you may be tempted to want to jump in as a possible entry right here. That is absolutely beautiful that you want to buy in at $5 support. That is great. But the thing is, what happens if the stock keeps on falling and the stock keeps on dropping and the stock keeps getting weaker? Well, if you have a total of, let's say, 1,000 shares on this play and this stock starts falling and dropping and falling and dropping and falling and fading, well, what's the issue? Well, now the stock is all the way down towards 450 and now you're in the red. And how much are you down? You just lost $500. But what could you do if you wanted to? You could say, well, I assume that we are going to see some sort of bounce play right at 450. So you know what I'm going to do? I'm going to buy in more shares. And if you buy in 1,000 shares at $5 and then you go ahead and you buy 1,000 shares at the price of 450, well, guess what? Your entry is no longer $5. You actually have a new entry on this play. And this new entry that you now have is going to be right here. And that's going to be at the price of $4.75. Now, how does that happen? Like, does this make sense? If we buy at $5, 1,000 shares, we are seeing the stock fall and fall and fall and fall. But if we buy another 1,000 shares at $4.50, that doesn't mean our average of where we have invested our money in stays at $5 because we invested down low. So now again, it's down to $4.75. And now let's just keep playing worst case scenario. Let's say the stock keeps on falling even more. If the stock falls even more and falls even more and falls even more, and the stock comes all the way down towards the price of $4.25. Well, now what could we do if we wanted to? If we wanted to, we could add another 1,000 shares right here. Now, if we add another 1,000 shares, what's our new cost basis? Our new cost basis is going to be the price of $4.50. We're actually going to get rid of this. We're not going to be at $4.75 since we bought down even lower. And our new cost basis at this time is actually going to be at the price of $4.50. Now, what's the benefits to this? What's the advantage of this? Why do we want to do this? And really the true benefit of it all is when the stock eventually does bounce, when the stock eventually does start moving itself on up, guess what? We will be able to make a lot of money. Because when the stock starts bouncing its way on up, before, what did we have to get up to? We had to get all the way up to $5. But now we only have to get up to the price of $4.50. And let's say it starts turning at $1.50. Okay, we could sell here. We could sell here and guess what? We would break even. Or we could keep holding our shares. And not only are we holding our shares, but we have, again, a ton of shares, don't we? We have 3,000 shares that we can buy that we already have. So if the stock starts moving its way on up and goes from $4.50 all the way up towards, again, like $5, well, we're going to be able to make a profit of about $1,500. How crazy is that? We just went from being down $500 to actually being up about $1,500. So this is a pretty amazing strategy when you think about it. Averaging down. Now, what are the pros and what are the cons of averaging down? Well, let's talk about the pros here. The pros here, team, is if you have the funds and you keep averaging down, you could technically never lose. Now, there is, again, a little bit of a lie in that. And what do I mean? Is if you keep averaging down on a good, credible play. If you average down, let's say on stock WAFU. WAFU, if we took a look at this play yesterday, WAFU, what did this stock do? This stock went from $5 and spiked to $7. Let's play worst case scenario. Worst case scenario over on WAFU is, let me again get all the prices here so you can see the prices over here. Let's say you bought 1,000 shares at the price of $6. Then you bought another 1,000 shares at the price of $5.50. Then you bought another 1,000 shares at the price of $5. Well, now you have a total of 3,000 shares right at the price of $5.50. Well, guess what happened? This stock didn't ever bounce back up, did it? This stock just kept going lower and lower and lower and lower and lower and lower. And guess what? You have 3,000 shares at the price of $5.50. The stock has fallen down to $4.50. That's minus 3,000. Now down towards $3.50. That's minus 6,000. And now down to around $3.25. You're down currently, around $7,500 on this play if you average down on this play expecting a bounce. So when it comes to penny stocks, averaging down can get very scary. But what do I mean that you could basically never lose? Well, let's think about it like this, team. You may know this or not. Dana White. Who is Dana White? He is the UFC president, the Ultimate Fighter. Okay, he is the president. You guys see again these fights on Saturday night pay-per-view. A lot of people watch it, and he is a multi-billionaire with a B. Now, something that he's known for is he enjoys gambling. He's always in Las Vegas. He obviously sets up a lot of fights there, but he enjoys gambling. And not only does he enjoy gambling, but he also gets kicked out of a lot of casinos. And it's a little bit tricky because basically the casinos ban him from gambling. And then he just says, okay, we're not having any more fights in this certain hotel. So he basically gets his revenge that way because he's not bringing in a whole bunch of people and bringing in a whole bunch of money. So why do they basically have to ban him? They have to ban a lot of billionaires. Because what happens when Dana White sits down and basically has an account of unlimited money? You know, the thing is, when a casino has you sit down and you play blackjack, for instance. And let's say this is you, okay? This is you, and we'll just say a normal person. You, again, sit down at the blackjack table, and you have a total of $500, which isn't bad. You sit down at a blackjack table, you have a total of $500. And you put, let's say, $100 on the table on a hand, all right? $100 goes right here. Boom. And let's say that doesn't work out. You lose in blackjack. Now, how much do you have? You have a total of $400 left. Okay, you have $400 left. And let's say you do that same process. You do the same process, you go ahead and play blackjack, and unfortunately, it doesn't work out. Boom. Okay, it doesn't work out. Now, how much do you have? You have 300 left. And essentially, you may have a couple wins. You may have a couple losses. You might go on a nice little streak, but then it usually ends up crashing on down. Why is it that casinos have to ban ultra wealthy people? Because the normal person, like let's say you, myself, anything along those lines, after we run out of $500, a lot of us may be tempted or not tempted to go out and take out more money because we don't want to lose another 500. We don't want to lose another 1,000. We don't want to lose another 3,000, 4,000, 5,000, depending on who you are as a person. What's it with Dana White? What does Dana White do? Which is why he never loses in a casino. Well, again, Dana White, he's a little different. Since he doesn't ever have to worry about money, guess what he does? He puts out $10,000, okay? This $10,000, he ends up losing. He loses $10,000. So guess what he does on the next play? He doubles it. And he says, okay, if I lost, I'm going to put $20,000 out now. So he loses this. And guess what? He loses this one and he doubles it. So now he says, all right, I'm going to put out $40,000 now. Because all you have to do in a casino, if you want to, is double your last bet that you lost on. And the moment he wins this, guess what? He makes back all of his money. If you lose $10, next bet on your casino, bet $20. Because that means the moment you win, you're going to make everything back. Then if you lose that $20, you bet $40. If you lose that, you bet $80. You lose that, you bet $160. You lose that, you bet $320. You lose that, you bet $640. But the thing is, guess what? If you lose, let's say 30 hands in a row, guess what eventually is going to be happening? You don't have enough money. You run out of money. You can't put up $40,000. And if you lose that, you got to go to $80,000. But what can Dana White do? Dana White can start with $10,000, lose, and then again, eventually all he needs is one win. He gets one win, and then he's back to even, and he's up 10,000. Then he does the same thing over and over and over again. So the thing is, and when you have unlimited money, you can just keep doubling whatever you have. right? And that's why Dana White never loses. You can literally just go to YouTube right now and just type in, if you want to, just Dana White gambling, or gambling banned, whatever you want to be looking at right here. And here's just like a quick little video.
This is crazy, but I've been on this winning streak. I started playing cards again December 21st this year. I have not lost a night of cards since December 21st. And we just hit them again. So this is like my part-time job.
It's like, obviously, because you just can never lose. So Deck, why are you telling us this story? Why did you tell us this story? What's the point of you telling the story? Because it's the same exact thing in the stock market. The same exact thing in day trading, which is why the strategy is kind of so crazy to think about, is what a lot of people do who have massive amounts of cash, right? Is they do this. Guess what? Listen to this now. So we'll see, let's say, a more credible play than WAFU. We could pick something, like if you want to go super huge like Tesla, but there's a lot of plays that are nice and credible, slow little uptrends that guess what you could do? You could, again, jump in on this play. Let's say the stock is moving on up, starts coming back on down. If it starts coming back on down here, guess what people do? They add here, right? Now, guess what happens? The stock starts falling even more. And guess what they do? They add here. And again, the stock starts falling even more. And guess what happens? Guess what traders do? They add here. And now again, the normal person may run out of money. But what do certain millionaires do? Hedge funds do. Billionaire traders do. They just keep adding. They add more here. Then guess what? It keeps on falling. Guess what they do? They add more here. Because eventually, a good, credible play isn't going to fall forever. Guess what a good, credible play will do? They may have been adding, and at this point, they may be right here with 30,000 shares. But the moment that this stock eventually gets that bounce play, eventually gets that move back on up, look at this, they're back in the green. And now they have 30,000 shares as the stock again starts working its way back on up. So that's what a ton of hedge funds are doing right now. A ton of hedge funds at this moment, team, are doing this over on, take a guess on what stocks. They're doing this over on, if we take a look, let's go to a weekly chart. They're doing this on PayPal right now. They're doing this on PayPal, where PayPal has fallen from $300 all the way down towards 95. And all they've been doing is adding shares for when this pops back on up. Same exact thing with Facebook. They are again just adding shares. So when it pops back on up, you wonder how people stay rich. How do millionaires not only just stay millionaires, but increasingly make money? Because when you basically have unlimited money, it's easy to never lose in the stock market. It's easy just to keep on going because eventually, if I look at Facebook, it's going to get a bounce play back on up. If I look at, again, PayPal, it's going to get a bounce play back on up. If I take a look over on Netflix, right? Netflix right here, at some point, Netflix is going to get back up above 400, get back up towards, again, 440, and that's what a lot of, again, these multimillionaires do. So you might say to yourself, wow, Deck, that does make sense. When you basically have unlimited amount of money or millions of dollars in your account, you could just keep adding and bringing down your cost basis until the point where the stock has to bounce eventually. And when it does bounce, you basically have brought your cost basis down so low that the moment it starts moving on up, you always make cash. So that's basically a strategy that a lot of Wall Street uses. So Deck, can we apply that to us as a day trader? Can we apply that to us as a penny stock trader? And the answer is yes, you can apply that, but you need to be more picky. You need to be more specific. You need to, again, be able to say to yourself, hey, you know what? If I'm going to get involved in this play, I have to have very tight areas. So for instance, guys, we already talked about penny stocks. Penny stocks are going to be very difficult to do averaging down moves on. And the reason why is because you got to make sure you're picking the right play. Make sure you're picking the top gainer of the day. Make sure you're picking a stock that's hot and credible. Make sure you're picking a stock that doesn't have a downtrend throughout the entire day. Right? We want to make sure we're not picking a stock that has a downtrend throughout the entire day. But the concept of this averaging down strategy is we want to try to find our bottoms. We want to try to find where the stock's going to, reverse at. So let's just take a look at, right here on PIK, and let's actually get rid of this downtrend. And even though this isn't, the best example, let's go ahead and look at, what we have offered today. Where could we have averaged down on this stock? Where could we have made money on PIK, even let's say if we didn't have the best entry possible? So we take a look on PIK, things that are standing out to me right away is I see that we do have our pre-market highs. Okay, pre-market highs right here. And then we do have pre-market highs. If we drag these across the board, usually pre-market highs are always going to hold up as a bounce area, especially next to the VWAP. So let's just add that, right? Let's add this line right here. So we can add that line, pre-market highs. So pre-market highs, always a great area to look for some sort of bounce area. And let's take a screenshot of this now and see what we can do. So if I was, again, looking for a bounce play, I could look at pre-market highs. And I could also look at, let's say, the VWAP if I was interested. So that's where, again, the best bounce would be. Starting off on this play, I could say to myself, all right, let's say I got in a little early. I see this as a little bit of support, so you start entering some shares. You're a penny stock trader. You enter, again, 1,000 shares right here. So let's go. You enter 1,000 shares, expecting a little bit of a bounce from the old support line. And you say, that didn't work on out. So what do? All you do then is maybe you add another 1,000 shares, back down towards this blue line. When this blue line hit, as you guys can tell, the stock had that very big spike all the way back on up. So, that's where you can make money. It comes down to you understanding support. If you don't know where support's at, you're never going to be able to make money. You're never going to be able to make cash if you don't know where support is to begin with. But as a penny stock trader, you just have to go into this and saying averaging down can help me. And there has been many times that I've seen a stock explode. I see it coming back on down and I say, okay, I want to get a dip buy. And I jump in right here. And you know what happens? The stock keeps on falling. So what do? I look for the next support line and I like to buy in right here. Now, again, my cost basis is right here. And next thing you know, the stock is starting to shoot itself back on up. And I make a ton of money and I make a lot of money and that's awesome. But the number one issue is what here? The number one issue is when traders say to themselves, all right, I'm getting here. I don't have any more money to average down. I have no more money. And the stock starts doing this then. This is the biggest problem. When stocks start doing this, still falls and still falls. And still falls. And now guess what? Now all you're doing is you're losing 2 times as much as you were losing before. So if you do not get into the right play, if you do not get in at the correct support lines, if you do not get in at or average down on a hot day in the market, you will blow up your entire account, right? You are going to blow up your entire account. And obviously that's going to make you extremely upset. So if you are going to work on this strategy, if you are going to practice this strategy, if you're going to try to become better on the strategy, what do you guys need to do? You need to have extreme discipline, which means what? You have to have some sort of hard stop loss. If you don't have a hard stop loss that says, if I lose this much, I will get out, you will sooner or later blow up your entire account. It's great to show you again, like kind of how the unlimited amount of money people do it. But as for a normal person, it's a great strategy, but you need to have still a hard stop loss because this will lead to you blowing up your entire account. It's the same thing when we talk about averaging up. Averaging up here, team, is when you're basically doing it on the short side. So let's say a stock is starting to spike its way on up. The stock is starting to move its way. You think, again, a great short area is going to be right around $5. So guess what you do? You start shorting the stock right here. Now, let's say the stock starts ripping and running up towards what area? Now the stock gets all the way up towards around the price of $5.25. So you know what? You say, man, the stock has just spiked so much. I want to short it here. Now I have a new cost basis at $5.15. And let's say the stock does start falling. Now you make a lot of money. But worst case scenario, it goes on a very big squeeze. Right? Trader Tom says averaging down, averaging up works about 9 out of 10 times, but that one time it doesn't work is going to hurt. Exactly. So how do I like to do this? I've gone over on this before in the past here, team, but how I like to, again, average down is what I like to call the imaginary box, right? You guys know this strategy. So let's just go over quickly the imaginary box for dip buying. So how would the imaginary box work for dip buying? Let's say a stock goes on a huge spike. Now remember, we always want to do it on very hot, very active stocks. And I say to myself, okay, where is this stock going to have its best bounce play? And I look at the past chart history pattern and I can see there's a very strong support line right here. So I put this blue line across the board, just like I would do on PIK. And I say to myself, this is where I want to enter. And let's just, again, keep our numbers nice and easy. This is $5 here. Okay. So I say when it comes down to the price of $5, I want to, again, get in on this play. That's what the normal person says. But what I want you guys to start doing is start putting a 15 cent up. So 15 cents up, 15 cent down imaginary box, which essentially means that surround that $5 mark, 15 cents up, 15 cents down. So that means we are going to be having an entry where at 515, 515. And we also have an entry back on down towards what? 485. Now, why is this important? Because the moment that this stock starts falling and dropping and starts getting weaker and weaker, now it hits 515. Why do we want to get in on our smallest shares at 515? Let's say we get filled, okay? Boom. We get in on this play and we are going to buy 500 shares. Something, again, kind of small, kind of tiny, 500 shares. Because how many times have you guys ever looked for a bounce play? How many times have you guys ever wanted to get involved in a play and it goes like this? You're like, okay, I got an order at $5 and the stock goes down to 407, 406. You don't get filled at $5 and it starts spiking its way back on up. That has happened to me many times in the past. So I always like to get filled. If I think $5 is bottom support, I'll look to get filled at 515. And I'm talking about if the stock, let's say, spiked up towards the price of $6. Like we went from $5 to $6. It's falling back down towards around the price of 515. Sure, let me do a small entry because it may hit 511 and start bouncing back on up. The stock has just fell about 90 cents. There could be a chance it bounces back on up. So right now my entry is 515 with 500 shares. Now let's say the stock keeps falling a little bit more. The stock falls a little bit more, stock falls a little bit more, and boom, I get filled right here. Well, let's make sure we have 1,000 shares right here. Now let's remember this, team. I just got filled at 515 with 500 shares. Now I'm getting filled 1,000 shares at the price of $5. What's my new cost basis? It's not 515, and it's not going to be the middle. It's not going to be 508 either, which would be the middle area. You might say, Deck, why is it not the middle? Because I bought more shares down low. So again, this investment at $5 is a bigger investment than it was at 515. So guess what, team? Now my new cost basis is more at around 505. So that's pretty neat, right? I basically got in at 515, and if it went up, great. If it didn't and came down to $5, I had 1,000 shares, which means that I'm going to put my cost basis right next to that area. And best case scenario is the stock starts moving its way on up. And now I have a total of 1,500 shares at the cost basis of 505, makes me even more money. Now, how many times has this happened to you guys? How many times have you guys ever got in at $5, the stock starts falling even lower, and you get scared and you get out? Very soon after, the stock all of a sudden shoots back on up and you say, man. So that happens a lot as well. So we like to cover that. So what do we want to do? Now we know this price is $4.85. And you know what we want to do? We got to add a little bit more. Let's say, again, we do 1,500 shares here. Now, just a little heads up. I know you might be saying, Deck, I don't have this much money already to do 500, 1,000, 1,500. Whatever your account is, change these. Do 100 shares here. Do 500 shares here and do 1,000 here. Just change it so it can work for your account size. Okay. So what would be the point of this? Because if this happened, if this stock, let's say, fell underneath 515, fell underneath $5, and now it's at our final area, we know now we do not have an entry at 505. We just got filled at 485 with 1,500 shares. What's our new cost basis? Our new cost basis is probably going to be back on down towards around like 496. 496 with a total of 3,000 shares now. So that's awesome. We have an entry under $5. We basically covered before our footsteps in case the stock did spike on up. And now we get filled at this bottom. And best case scenario is we're in at 496. It comes up to our entry. Now we're in the green and now we make money. So that's great. Now I know what everyone's thinking. Deck, what if the worst of the worst happens? And what's the worst of the worst? Like WAFU, where WAFU, guess what it did? All the stock did was come crashing on down. Well, underneath this last line, you got to have a hard stop loss, right? You got to have a hard stop, which basically says if it goes underneath this line, you're done. So you have 15 cents up, 15 cents down, 20 cents or lower. That's where your stop loss is at. So you would lose from 496 down towards, again, the price of 480. 496 to the price of 480. You might take a $200, $300 loss, but you would be able to win like $2,000. So, that's basically great reward to risk. And it's the same exact thing, team. If you wanted to flip the script here and look for, again, some possible shorts. If you flip the script here and look for a possible short, you would do the same exact strategy where essentially stock is spiking on up here. And as the stock comes up to $5, you're doing the same thing. Stock comes up to $5, put an imaginary box around $5 if you want to short it at $5. That means guess where you're getting filled? You're getting filled right around, let's say, 486, 47. Doesn't have to be 15 cents exactly. You could do $5 right here, and you could do 512 right here. Let's say normal case scenario, it runs up to 490, then starts dropping. You got this covered, right? Another case scenario, the stock runs up towards the price of 501. You got filled at 46 and $5, then it starts falling. And then the last case, it runs up to 512 and then it starts falling. If it's spiked up towards around 520, we have our stop loss to get us out. So we're basically, as a trader who doesn't have unlimited amounts of money, we have to, again, follow this strategy, as this strategy is going to help us. When you're Dana White and you can just win as much as you want and you never have to worry about it, or lose as much as you want, you never have to worry about it. That's, again, a completely different world. When you're, again, a multi-million-dollar hedge fund, that's a different world. For you only having a few $1,000s, that's the strategy that you guys want to be looking at. So I wanted to go over averaging up. Wanted to go over averaging down. I wanted to take the time to make sure that you guys understand it. I wanted to review again the imaginary box strategy. And now you guys can always be able to find that perfect entry. You guys can buy. If you want to do an imaginary box strategy, you can still do it even underneath the PDT rule, because you can buy, you can buy, you can buy. Then you can sell, you could sell, you could sell. You could still do that underneath the PDT rule as well. So make sure you take what you've learned here, understand it. But really the best area to put that imaginary box strategy is going to be from what? Studying support lines. If you understand support, that's where you guys are going to have the most success. And I want you guys to get over to tradecaster.com. Make sure you guys click the video library and go on down. We have level 2 bootcamp, shorting bootcamp, entries and exit bootcamp, and we do have support and resistance bootcamp. And this is going to be going over everything, teaching you guys, of course, about support and resistance. So we have about an hour-long lesson here going over and teaching you guys how support and resistance is and how you guys can find the best support and resistance lines. So make sure you guys check that out if you guys haven't yet. All right? But take this averaging up and averaging down, absolutely kill it as always, and make that big time money, baby. That's what it's all about, traders. Ahoo!